The car costs $30,000. At least that is what the sticker says. 6 years later, the car is worth a fraction of that. The loan is finally gone. The insurance bills are finally gone. The maintenance bills are finally gone. And the driver has discovered something unpleasant. That $30,000 car was never a $30,000 purchase. It was a financial journey. And every mile had a toll booth. Today we are following the money trail. From the dealership to the lender. From the lender to the insurance company. From the insurance company to the repair shop. And finally to the used car lot. Stay to the end because the most expensive part of the car is the part you cannot see. Imagine a car sitting on a dealership floor. The sticker says $30,000. Maria walks in and likes the car. She thinks she is buying transportation. But before Maria drives away, several hands touch the money. The dealer wants to make money. The lender wants to make money. The insurance company wants money. The mechanic wants money. The government may collect taxes and fees. And the car itself starts losing value. The $30,000 sticker is just the beginning. Maria signs the paperwork. The dealer sells the car. The lender provides the borrowed money. Maria drives away. The dealership has completed its journey. Maria's journey has just started. First comes the price. The car has a sticker price. But the final purchase price can include taxes, registration, documentation charges, and other fees. So Maria's $30,000 car may require more than $30,000 before she even turns the key. The exact amount depends on where she lives and what she buys. But the principle is simple. The sticker is not always the final bill. Now comes the loan. Maria does not have $30,000 sitting in a drawer. So she borrows money. The lender agrees. Maria promises to repay the loan over time. This sounds harmless. After all, $30,000 is still $30,000. Except money has a rental price. That rental price is interest. The longer Maria uses the lender's money, the more she can pay for the privilege. A loan is not just a purchase. It is a purchase stretched across time. And time charges rent. Maria chooses a 6-year loan. Her monthly payment looks manageable. That is the first trick of the journey. The monthly payment feels small. The total cost feels distant. A few $100s every month does not feel like $50,000. But the calendar is patient. Month 1 arrives. Maria makes a payment. Month 2 arrives. Another payment. Month 3 arrives. Another payment. The car sits in the driveway. The lender's balance slowly falls. But the car's value is falling too. Now the journey gets interesting. Maria still owes thousands of dollars. But the car is already worth less than it was when she drove it away. This is depreciation. The car is losing value simply by getting older. Mileage climbs. The odometer moves. The warranty gets closer to expiration. The showroom smell disappears. The car becomes used. And used cars usually command less money than new ones. Maria has 2 clocks running at once. The loan clock counts downward. The car value clock counts downward too. Sometimes the loan clock moves slower. That creates a gap. The car might be worth $22,000. Maria might still owe $25,000. If she sells the car, the buyer gives her $22,000. The lender still wants the other 3. The car has left her hands. The debt has not. Now notice the absurdity. Maria can own a car that is worth less than the debt attached to it. The driveway contains an asset. The bank account contains a liability. And the 2 numbers do not match. This is why the journey matters. The car is not just transportation. It is a moving financial balance sheet. Now Maria needs insurance. The lender has a reason to care. The car is collateral for the loan. If the car disappears, the lender still wants its money. So Maria may need comprehensive and collision coverage while the loan exists. Now another bill enters the journey. Insurance. Maria drives to work. She pays the lender. She pays the insurer. She pays for gasoline. She pays registration costs. She pays for maintenance. The $30,000 car is becoming a subscription. Except subscriptions usually do not require a mechanic. Now imagine Maria drives 15,000 miles a year. The tires wear down. The brakes wear down. The oil needs changing. The battery eventually weakens. The car is still sitting in the driveway. But money keeps leaving it. That is the strange thing about ownership. The purchase price happens once. The ownership costs happen repeatedly. Now the loan enters another dangerous zone. Maria has been paying for years. She feels like she owns the car. But the lender may still have a claim on the vehicle until the loan is fully paid. Maria has spent thousands of dollars. The car has lost thousands in value. And the interest has added its own cost. The payment is doing several jobs at once. Part of it reduces the loan. Part of it pays interest. Meanwhile, the car is aging. The odometer does not care about Maria's payment schedule. Now picture a $30,000 car as a bucket. Maria fills the bucket with borrowed money. The lender takes some money every month. But the bucket itself is slowly leaking value. That is depreciation. Maria keeps pouring money into the loan. The car keeps losing resale value. The lender gets paid according to the contract. The car gets older according to the calendar. Neither one waits for the other. This is why a long loan can feel comfortable at first. The monthly payment gets smaller. But the journey gets longer. Maria pays interest for more months. The car gets older while she is still paying. The risk of owing more than the car is worth can last longer. The monthly payment is easier to swallow. The total financial meal is not. Now we reach the part nobody sees on the sticker. The money trail. The dealer receives the purchase money. The lender receives interest. The insurer receives premiums. The mechanic receives repair money. The fuel station receives gasoline money. The government collects taxes and fees. The car loses value. Maria receives the keys. Everyone gets a piece of the journey. Maria gets transportation. And transportation is useful. That is important. The car can take her to work. Can carry groceries. Can help her earn income. The problem is not that cars cost money. The problem is that the sticker hides the full journey. Now return to the $30,000 car. Suppose Maria pays additional taxes and fees. Suppose she finances the purchase. Suppose interest accumulates over 6 years. Suppose insurance costs thousands. Suppose maintenance and repairs arrive. Suppose the car loses a large portion of its original value. The exact total depends on the loan rate, location, insurance profile, vehicle, and maintenance. But the financial lesson remains. A $30,000 car can easily create a much larger lifetime cash outflow. That does not mean the car itself costs $50,000. It means Maria can spend $50,000 or more across the entire ownership journey. Those are different numbers. The sticker price is one number. The total cost of ownership is another. And confusing the two is how people buy monthly payments instead of cars. Now convert the car into ordinary working life. Suppose Maria earns $25 an hour before taxes. $30,000 represents 1,200 hours of gross wages. That is 1,500 8-hour workdays. Or nearly 300 full 5-day workweeks. And that is before taxes. The car is sitting in the driveway. Maria is still working to pay for it. Think about that. The car may take more than a year of full-time gross labor just to match the sticker price. The loan adds time. Insurance adds time. Maintenance adds time. Depreciation removes value. The journey keeps going. Now imagine Maria's 6-year loan. 6 years is 72 monthly payments. The car gets older 72 times. The lender gets paid 72 times. The insurance company collects premiums 72 months at a time. The odometer keeps moving. By the final payment, Maria may finally own the car outright. But the car is no longer new. It has become an older machine with a history. The journey has reached the final stop. Maria sells the car. The buyer hands her money. But that money is much smaller than what she originally paid. That is depreciation. The car's value has traveled in the opposite direction from Maria's payments. Maria paid the lender until the debt disappeared. The market paid Maria based on what the car was worth now. Those numbers rarely match. This is where the money trail becomes clear. The dealer was paid. The lender was paid. The insurer was paid. The mechanic was paid. The fuel station was paid. The government collected its share. Maria paid everyone. And the car still ended the journey worth less than where it began. That is not a conspiracy. It is how the economics of car ownership work. The darker mistake is believing the monthly payment tells the whole story. It does not. A monthly payment is one frame from a very long movie. The sticker price is another. The interest is another. The insurance is another. The repairs are another. The depreciation is another. Put them together. Now you can see the actual journey. The $30,000 car was never just $30,000. It was $30,000 plus the cost of borrowing. Plus the cost of keeping it insured. Plus the cost of keeping it moving. Plus the value it quietly lost. The car did not rob Maria. The calendar did not rob Maria. The lender did not necessarily rob Maria. The real trap was failing to follow the money past the dealership. Because the most expensive number on the car is rarely printed on the windshield. It is hidden inside the years. And by the time Maria finishes paying for the car, she finally discovers what she actually bought. Not just a $30,000 machine. A 6-year financial journey. And every mile had a price.